Good afternoon, everyone, and welcome to today's webinar. The topic is, are we in a market housing bubble? We have Jay Rout. I'll introduce myself here first. I am Susanna Famiglietti here at Northwest Federal Credit Union. I am one of the loan officers here at the Herndon branch. I'm going to be starting with a section of loan products and some information on Northwest benefits. And then I'm going to turn the webinar over to Jay Rousey. He is one of our Home Advantage agents, and he is with Living Realty LLC. And he has a lot of really good information on determining whether we're in a bubble or not. So stay tuned for that. If everybody's ready, I'm going to go ahead and get started here. And my screen, my PowerPoint isn't turning. Let's see, let me try this. Okay, here, sorry about that. My arrows weren't working. Okay, so the agenda is I'm going to cover some mortgage loan options. I'm going to also talk a bit about the Home Advantage program benefit. And then Jay Rousey is going to talk about the real estate market is it in a bubble or not in a bubble? Okay, so here we go. Although the rates have been going up since the first of the year, our rates are still very competitive, and Northwest does have quite a few unique loan products. We also offer free pre-approvals if you're purchasing. That pre-approval is good for 4 months if you want to apply for a pre-approval to purchase. And then the Home Advantage program, we're going to talk about that a little bit later. I do want to touch on the home equity loans. If you already own a home and you're looking to take some equity out, we have very competitive rates and a pretty good deal on our home equity loans for primary residences, second homes, and investment properties. For the primary residences, Northwest does pay up to $1,000 in closing cost credit. We are a national lender. We do loan in all 50 states. And we also service the life of the loan. So our servicing department is located right here in Herndon, Virginia as well. So from the time you go to closing on your loan and you have any questions, you can contact our servicing department. We're not selling to another lender. And here's the interest rates. The interest rates are in the fives now, in the low fives now. And if you take a historical look, the rates, although they're a little higher today, they were much higher, like in the 2005 to 2010 time frame. And here's some of our mortgage loan products. We have an in-house product of 100% financing. That product can go up to $647,200. Please know that 100% financing product we can process with or without private mortgage insurance. The one without the option without the private mortgage insurance does have a bit of a higher rate. The 100% financing is for primary residences. So if you're looking to, you don't want to put down a down payment, just please know you would still have to pay for closing costs, but you just wouldn't have to have a down payment. Also, the next product is a regular Fannie Mae product for the Home Ready program. It's 3% down. When I can get borrowers, especially first-time home borrowers, into this program, I choose it because it usually has a better, uh, the better rate and the better private mortgage insurance option that has a better rate with that as well. It's good for refinances as well, and you do not have to be a first-time home buyer to get into the Home Ready. It does have limited income guidelines. So we have to always look at what the limit is in the area that you're purchasing in to see if the Home Ready would work for you. We also have VA loans. The VA loans, the Veteran Administration loans, do go to up to 100%, and our rates are very competitive with them as well. We do offer a 15-year and a 30-year fixed rate on the VA loans. And investment property loans. The investment property loans now, we just added to the investment property products. We offer now the 10-year, the 15-year, plus we also offer the 20 and the 30-year in the investment property loans. The investment property loans usually require 20% down. If you did a little less than 20% down, of course, the private mortgage insurance would apply as well. And then moving on to the jumbo loans, we can loan up to $2 million on the jumbo loans. The jumbo loans are in-house, and we do offer the 15 and the 30-year fixed, plus we have several ARM options, adjustable mortgage rate options on the jumbo loans as well. I'm going to move forward here to the next slide. I just want to make sure that I didn't skip a slide because my keypad here seems to be sticking a little bit. Okay, so go back. It has a delay on it. My apologies. Okay, so I'm just going to check this real quick. I just want to make sure that I didn't. Okay, so this would be the next slide. My apologies for that. Okay, so if you don't want to submit an application for a pre-approval, you can always go directly to our website and pull a quote. And I want to mention that although this is like you can check rates here, you would put in what you're doing. Are you purchasing or refinancing? Are you doing an equity loan? If you're doing a purchase, you want to put in the purchase price, the loan amount, the state and county and city, and then there's a few more fields below here where you would put in like what the range of your credit score is, and if you're buying a single family home or a condo, or if it's a primary residence. When you complete all those fields, this would just be a quote. If you click go, it'll pull up all the loan products that you would be eligible for. So, and that's what you would check the rates on. So you don't have to apply for the pre-approval just to get the rate. If you know what your scenario is, you can determine your rate by just doing this quote. Also, if you want to apply, you would apply from here as well, so you could submit your application. And I do want to mention on the pre-approval loans, when you submit your application, it does pull a hard hit on your credit. That's required for us to get you release a pre-approval letter. It's a tri-merge report. So we pull from Equifax, Experience, and TransUnion on a tri-merge report for our pre-approvals. Also, once you submit your application, when you submit it, it is good for 4 months. So you have 4 months from the day you apply for the application that it's good for. When you find a property and you send us a contract, we use the same application. We just modify we add the address and your sales price and what your loan amount is. We update it, and then we get email you the new disclosures. And your rate locks, I do want to mention this because the rates, that there's been a few days that they dipped, but unfortunately they've just continued to go up as well. And the rates on pre-approvals are not locked. On to the next page here. Okay, so the next page here, it talks about the Home Advantage Cash Rewards Program. So the Home Advantage, Jay Rousey, that is with us today, he belongs to the Home Advantage program. That is what that program is. I believe we have agents in 35 states now across the country that have these real estate agents that belong to the network of the Home Advantage and their credit union. They belong to the credit unions, and the credit unions will offer this program. So here's an example. If you use one of those Home Advantage agents, they do give you a cash reward of 20% of their commission. So if your home is $500,000, at closing you would get $3,000. Most of my members, they take the $3,000, put it towards their closing costs, and that's just less $3,000 that they have out of pocket. Okay, so let's see for the next slide here. And now that was the end of my slides. And so now I'm going to turn this over to Jay Rousey, and he's going to talk about the current market situation that we have going basically across the country. So, Jay, it is your time to talk.
Sounds good. All right. Good afternoon, everyone, and welcome to this webinar. Again, my name is Jay Rousey. I'll give you a little background about myself. I am from the Northern Virginia area. I've spent my entire life in Northern Virginia and my entire professional career, first as a licensed real estate appraiser in the state of Virginia. And then that started in 1993 doing my apprenticeship, which takes a couple of years, and then received my license at the beginning of 1996, and then switched over to the real estate side in 2006. So I have been working almost 30 years in this Northern Virginia real estate market. We were a team of agents that were with Keller Williams, and then about 8 years ago we left and started our own small niche firm called boutique firm called Living Realty. And we are based out of Ashburn, Virginia, but we cover pretty much all of the Northern Virginia area. I do realize we do have some folks on this webinar that are from other states, so we'll try and keep this broad to the overall real estate market, but please be aware the conditions in your area could be slightly different than what I'm discussing, what we're seeing here in our Northern Virginia market, which is right outside of Washington, D.C. So as many of you have probably seen just by reading any articles or looking at the home prices in your neighborhood, over the past few years, we have seen home values skyrocket. Pricing on homes have gone up dramatically during that time, and there's quite a few reasons why. This trend did start before the COVID pandemic. We were starting to see a lack of supply going back as early as 2017, 2018, and as we'll have some slides that show that. But then when we did hit the pandemic in the beginning of 2020, we did see the shutdown of the economy to a certain degree where everyone was on lockdown and things of that nature. People weren't going to work any longer. And what was fascinating was many people thought this would cause a real problem in our real estate market, but it did the exact opposite. As people started working from home, we saw a significant increase for people wanting and demand for people wanting to work from home in larger homes and things of that nature, and outside of the major metropolitan areas, moving further to the suburbs and things of that nature. Also at that time, the Federal Reserve, the U.S. government through the Federal Reserve, began pumping huge amounts of money into our economy. One of the main things we saw were some stimulus programs for those the companies that were losing business because of the pandemic, but also people getting the government stimulus checks during the pandemic allowed a lot of people to significantly take that money and invest into homes or into their own homes, things of that nature. The banks were given money through the Federal Reserve, and that money was then handed down to individuals, to families throughout the country, and we saw a significant change in the real estate market beginning in the summer of 2020. where we saw our supply dramatically decrease. And it was a very interesting time. During that period, I was showing houses, and I saw the joke that everybody who was showing houses looked like surgeons. We were in masks and gloves and hand sanitizer and wipes and anything you can imagine just to go in and see the house. And there were often lines of people waiting outside to get into the properties. That has continued to do so even into this time now. We are seeing a significant decline in inventory. Especially, again, I can't speak to your individual area if you're outside of the Northern Virginia area, but still in Northern Virginia, we are seeing a reduced inventory problem here. As the Fed was trying to stabilize the economy during that shutdown, one of the things they did also was keeping interest rates artificially low. So during that time frame, we saw interest rates at one point, 30-year fixed rate as low as 3%, and even into the high twos just for a couple weeks period of time there. That obviously caused people who wanted to have a home and wanted to work from home to jump into the market, and we saw a huge uptick in first-time home buyers as well. So as rates stayed low, more people entering the market, more people nervous during the pandemic of not wanting to move maybe. Again, we just saw a very a significant decline in our inventory while having a huge increase in supply, in demand. So as people were spending on that, we also started to begin to see the supply chain issues that have only continued through today. Those began in 2020, but have been significantly exacerbated during that time frame to now. We are starting to see builders who are having trouble getting enough inventory in terms of their supplies they need. I just had a builder this summer who, in the middle of the house being built, they had to change their cabinet supplier, and we had to come back out. It caused about a 30-day delay on settlement as they waited to change over to a new cabinet supplier, which was a very challenging situation to have every buyer come back in and get all of those things redone. So again, that's been one of the challenges we have seen. Okay. Let's see here, advance the slide. Okay, this next slide here is, again, this is a nationwide kind of trend here of what we've seen over the past few years. So these, if you're in Northern Virginia here with us or in the Metro DC area, these will be significantly lower than what we see here. But this tells you what we have seen in existing home prices since 2019, going from 271,900 to 296,700,000 to 347,100 over that 3-year stretch. That is a huge jump on the nationwide level. And you saw that existing home prices, single families, you can see the difference in co-ops, condo or co-ops. So again, just a significant jump, even beginning in 2019 into 20 as we continued in this market. So for those of you who are here locally, this next slide is very helpful. Fairfax County, one of our largest jurisdictions right outside of Washington, DC. And again, we have seen a significant growth. This goes all the way back to Q1 of 2017, where in Fairfax County, median sales price was under $500,000. Now we are well over $600,000. And as you can see, these do dip from quarter to quarter. Traditionally, our strongest season is the spring season, which is kind of where you see the largest, the bar hitting its highest number. I can tell you from first quarter statistics that we are just getting in for this year, we are seeing that number even higher now. Our median sales price in Fairfax this year is jumping even higher than it was in the second and third quarters of last year. So again, Fairfax County seeing that large growth, and we are going to also see that in the next couple slides. Here we go into Loudoun County. So again, Loudoun County, our median sales price has increased significantly since 2017. And as you've seen, it's just been a general growth period, but then we've seen serious spikes over the past 2 years. One thing I did want to add in, Susanna asked me to mention, I just want to make sure, if you have any questions, you can submit them through the webinar, and at the end, we will be taking questions at the very end of the seminar. So please, if you have any questions, feel free to submit those. We will be finishing before our 1 o'clock time, and we'll hopefully be able to take questions before 1 p.m. And then we'll also stay a little later if we need to take them after 1 p.m. for those who want to stay. But again, going back to these median sales prices, we are seeing just a significant growth in our median sales price in the spring of 2022 here, it is going even higher. So, and then we'll look at, I picked these 3 counties because these are our largest counties in Northern Virginia, but you would see these trends throughout all the counties in the Metro DC area. So just be aware of that. Okay. So Prince William County, another one of our large counties here, you again are seeing this trend. I just wanted you to be able to see it in real world form of what we have seen over the past few years, and the spikes have been just so significant. The number one question as we finish looking at these statistics that I get every week is, Jay, are we in a bubble and is it ready to burst? And should I just hold off based on what we are seeing? And that is a challenging question. And there's anyone who tells you they know for sure, beyond a shadow of a doubt, what's going to happen. I honestly, I would not trust them. But we are seeing some signs of what is going to potentially happen here based on our current market. And one of the most significant things, as Susanna just mentioned, that we are seeing is interest rates are rising. The Fed has started to raise the prime rate, which is causing interest rates to rise too, through what the Fed is calling a little bit of quantitative tightening. It's what they're trying to do right now. And they're basically wanting to get these rates up as the market changes so that we can, they don't want to stall the market, but they want to have more balance to the market. They know it's been an unhealthy rise that we have been seeing over the past few years. Some great quotes here that we are seeing at this point, and I think I need to go back one slide. Give me just a second. Hold on. Sorry, my mouse was going a little crazy there. So again, this great quote here, this is from one of the chief economists for Redfin, which is obviously a large nationwide brokerage, as well as a company that tracks these numbers. There is a historic correlation between rising interest rates and lower home price growth. In a typical year, if mortgage rates increase by 1%, there tends to be a 5% drop in price growth. And in this parentheses is very important. This is not a drop in actual price, but in the pace at which sales prices are increasing. This is what I think we need to be aware of and start looking for over the next few months and the rest of this year. We have seen interest rates go from 3.5% just maybe a month ago or even 6 weeks ago to now, as Susanna said, seeing those prices in the high 4s and low 5s depending on the day. So this is the thing that we are tracking. We are tracking the pace at which sales prices increase. We have been seeing values increase substantial amounts in very short periods of time. Especially the spring, we have seen that. So we are looking to see if that pace is what will decrease as the year goes on. Again, so as we talk about these different metrics and things we track, we haven't seen this happen quite yet. So we haven't seen the pace of sales increase or decrease yet, the pace of the actual price increasing or decreasing yet this year. But we are just, in my opinion, starting to see the very early signs of that. So a perfect example is earlier this morning, I went and was at a home inspection for a buyer that I am representing. This is the first home inspection I have been on this year. The last home inspection I attended was probably December. And because of the increase that we have seen this year so far, I have not seen a single home inspection on any of my buyers. They have basically been waiving the home inspection. In other words, choosing to purchase a house without an inspection, which again is we in the real estate industry realize that is a significant risk. We have buyers who are basically saying, Jay, we want to get in and we are willing to do that after they see the home. They do their best to find out if we think there's any major issues with the house. In some jurisdictions, they are even allowing what we call pre-purchase inspections, where you can bring an inspector along to walk with you during the showing period to see if there's anything major, but even that is not a full home inspection. So this is something that if you're outside of the Northern Virginia area, would be very, very smart of you to talk to your local realtor, if you can find one in the Home Advantage program, to see what is customary in your area. We see different things happening in Northern Virginia than are in Maryland, than are in DC. each jurisdiction has kind of some unique things that are happening with regards to home inspections and waiving the home inspection and waiving appraisals and things of that nature. So very important to talk to in your local community. I'm talking about what we're seeing here in our local market. But again, as this quote says, we haven't seen the market have that problem yet. The increase in rates has actually led to a spike in demand just in the past few weeks. But I do believe this is maybe just starting to see that change occur, as I said, with the home inspection this morning. And I think it's very important to talk to your realtors as we go forward to see what they are seeing day to day and week to week, because it is changing. The bottom quote here is very important. The market was in need of higher rates in order to sort out the balance of how much the prices have grown. We need to get more balance between supply and demand in our markets. So I personally just don't think we can handle the insane growth that we have seen over the past 2 years, especially. So with rates going to 5%, I can tell you in good faith, I have seen some buyers that are, in the next slide we're going to talk about here, that are already facing affordability issues. I have a couple of clients this year who are young single family, first-time single family buyers looking to buy either a townhouse or a single family home. And because of the increase in rates, they have already made a decision to hold off for a little bit to see what happens. The affordability of a house goes down dramatically when rates go from 3%, 3.5% up to 4 to 4.5 to 5%. Depending on the price of the home, that can be a difference in monthly payment of several $100s. So the interest rates being higher right now is leading to some of these issues that I think are going to trickle down even further as the year continues, if, and this is a huge if, interest rates stay where they are at, because we are seeing buyers that are holding off at this point or are changing the price point at which they're purchasing. I just had a client last week who had been looking at houses in the 550 to 600 range. And because of interest rates going up, they sat down with their loan officer, like someone like Susanna, and said, okay, how much would this monthly payment be now at 5% instead of 3.75? And they lowered their estimate. Instead of looking 550 to 6, we're now looking 475 to like 525, 550 at the absolute high end. So that's going to impact our market as things go forward. Again, this bottom quote is great. We've been in such a low rate environment with rates below 5% for so long. Psychologically, that number can become a barrier. I tell people all the time, we have to look at this from a big picture perspective and think about it this way. If our market should slow a little bit, at least here in the Northern Virginia area, if rates are higher and they're closer to 5%, that's very scary for people psychologically. They think it's time to back off. But if our market can cool down a little bit, and instead of properties being bid up to well above asking price, and we can get back to a scenario where people are paying, at asking price, or maybe barely above asking price, or maybe even below asking price, there could be a scenario where your monthly payment would be similar to if you had just bid up a property another $20,000, $30,000, $40,000, $50,000. So keep that in mind. You have to try and look at the entire, take a perspective from a big picture and understand what you're looking at and what that monthly payment would look like for you individually. So very important to keep in touch with your realtor and your lender to discuss all of these situations. One thing we are also seeing that's smart to keep in touch with your loan officer like Susanna is I see people, as Susanna said, your pre-approval is good for up to 4 months. The pre-approval, though, you want to sit down with your loan officer and have a discussion about what would that monthly payment look like with these higher interest rates. So I just had a client this week who was approved 2 months ago with their lender. And I said, you need to go back and chat with them and see what that monthly payment looks like. And that was the one who adjusted their sales price and what they're looking at lower once they sat down and reviewed what that monthly payment will look like. So it's very important to have that partnership between your loan officer, your realtor, to discuss our current market conditions, because rates are changing. So, okay. Big question, will the bubble burst? So I personally believe we are going to have a correction in our market at some point. But again, probably the second question I get asked is, if we have a correction, how much will prices drop? Will they drop? Will it be like 2006 to 2009, where we had the huge recession? That was our worst since the Great Depression. I personally don't think it's going to be nearly anywhere near as bad as we had during that time frame of 2006 to 2006 to 2009, because our fundamentals behind the scenes are much, much better than they were during the financial crisis of 06 to 09. During that time frame, we saw people who were putting down almost no money, many people using 100% programs, and we also had much more lax approval standards during that time. The story I always tell, I was sitting across from a client, from a seller, a buyer who was buying the home that I was the listing agent for, and the person across the table, who by law, I'm not allowed to discuss their situation with them. That's between them and their realtors. They were signing documents in English, and English was not their first language, and it was clear to me they barely spoke any English. And they probably should not have been buying that home, because I could see what their payment was. They were putting down no money, and it was a very scary situation. You have people like that who were buying houses on the hope that the values would keep going up, but they really had no money to put down. Many of those houses ended up in foreclosure or as short sales. What I can tell you from our local market here in Northern Virginia is that purchasers are putting down much larger down payments than they were during that crisis. We have clients, it's very rare. We do have some that are doing no money down. That is the occasional one, but what is much more likely is seeing payments on the low end down of 5 to 10%. And in many cases, we are seeing people put down 20, 30, 40% of a house's value. So I just had one last month where the purchaser paid all cash for a house, which is unbelievable. And they bid that price up a good bit from the original list price. Waived all inspections, waived the home inspection, appraisal, financing contingencies, because obviously they were paying cash. They didn't have to worry about those. So we are seeing people who are much better qualified. And I can tell you from the clients that I meet with here in our market, they have excellent credit. Even if they don't have a huge down payment, they have very good income, very secure jobs, great credit scores, things of that nature. So we are seeing a much better fundamental foundation of our buyers in this situation now that we are going through. Having said that, with the higher interest rates, I still think we are going to see some type of a correction at some point. So be aware of that. And again, what we are also seeing, banks are in much better fundamental shape than they were during our financial crisis. During that time, banks were using what they called mortgage-backed securities. They were buying them from lenders. So as they bought these, what lenders do is they will package entire groups of mortgages into a security that banks then buy. And we had large national banks who were buying these mortgage-backed securities. The problem was those mortgage-backed securities were from people who should not have been buying homes. They did not have great credit. They didn't have down payment. They didn't have enough income. And they were also buying properties on what we called ARMs, adjustable rate mortgages. So a 1-year ARM, a 3-year ARM. So when those ARMs expired, those adjustable rate mortgages, their interest rate went up. And many of those are what caused the problems of foreclosures and short sales. The banks who bought these mortgage-backed securities obviously started getting into significant financial problems as properties went into foreclosures and short sales during that time. These risky loan products that were used during that time, the last bullet point on this slide, we are still seeing the occasional ARM, but those ARMs are only being used by people who are incredibly well qualified, who have large down payments and things of that nature. So overall, as we ask the question of, is this bubble going to burst? The real key is, what are our fundamentals behind the scenes? And they are in a much better situation than we were in the previous crisis that we had in the 2000s. Having said that, that doesn't mean we are not going to have corrections. We have always had corrections throughout our market here in Northern Virginia, and we'll talk about that in a slide a little bit later. But overall, we are in a much better situation. So again, the big question I get asked often is, how do we survive it? If I buy a house now and the bubble starts to correct, or we don't, hopefully we don't have a bubble burst, but we just have a correction, how do we survive that? Some of what I just talked about is very important. The fundamentals are better now because people have larger down payments, but you have to be able to stay in your property if we have that correction, okay? So as that correction occurs, if you can stay there because you have good annual income in your family, if you have low debt to income ratio, as we call it, DTI, where you don't have much debt and your mortgage payment is reasonable and you can keep it if the properties start to drop, the values start to drop, you're going to be in a much better situation. Too many of the folks in the financial crisis that we had could not afford the higher mortgage payments when their arms came due. They also had other debt. They had low credit scores and things of that nature, so that when things got in trouble, they ended up going into foreclosure or short sale. So the other thing I talk about with young clients, especially, if you are buying a house and you don't have a lot of cash, set up a plan and get in place where you have some cash reserves to be able to lean on in case we have a correction in the market. So if you need that extra money in case there's something that needs to be fixed in your house, you need to have the cash reserves and make those smart decisions ahead of time, so that if your furnace needs to be replaced, or if your roof has a leak, or something breaks, that you have the finances to not only hold on to your house with your monthly payment in terms of that being reasonable, but have cash reserves to make any repairs in your home so that you don't end up having to go into foreclosure. Very important to make your smart decisions ahead of time. Back during that crisis, we saw people with very poor planning who did not have those cash reserves and did not have the means to afford their house. And again, combine that with lenders taking the risks they did, put us in a very, very delicate situation. But now, very important to do this, have the cash reserves, know your monthly payment ahead of time. The other thing I tell everyone, I don't care what your lender puts on a piece of paper that you are pre-approved for, you need to make sure that you can afford your monthly payment. That's the most important thing. With that, picking the right program is hugely important. So a 30-year fixed rate mortgage is much more secure in terms of what your payment will be from year to year than an adjustable rate mortgage, an ARM. So an ARM is a very good product, and I don't think they are horrible in and of themselves. I think they just have to be used by the right person who is taking out that loan. So be very careful. Talk about that. Do you want to do a 30-year loan? If you're going to do that, what does that monthly payment look like? It shouldn't change that month. The only typical thing that changes in your mortgage payment would be if your assessment from your local jurisdiction goes up, or if your insurance goes up for some reason. So, but that payment should stay fairly stable throughout your time frame. And then also be smart. Think about, will you be getting pay raises down the road so that you can put more money into cash reserves and things like that? So again, make some smart decisions. I tell folks nowadays, especially my young first-time home buyers, meet with a financial planner, get a plan in place, know what you want to do long-term and have that plan. Don't buy a house just because everyone is. Make sure it's the right decision for you. The other thing I tell people all the time, if you are looking to buy right now, how long are you going to be able to stay in that property? If you're in a situation where you know you're going to be moving in 1 to 2 years or 3 years, now is probably not the right time to be buying. But if you know for a fact that you can stay in that property for 5 years, 10 years, 15 years, then you're probably going to be okay, because any correction that occurs is going to come back around and values will go back up down the road. What I tell people all the time is that as values come back up, you're going to be in good shape again one day. Perfect example is my own property that I bought in 2004 that I still live in. When I bought that, values went up significantly between 2004 and 2006 when the values peaked. And then they came back down, and my house for a period of time was below what I had paid for it in its value. But I was able to hold on to that property, and here we are many years later, and that value is now higher than the peak value in 2006 and a good bit above that. And on top of that, I've been paying down the mortgage. So I was not going to have to worry about getting foreclosed on because we were able to stay in the property. So, okay. This is a very important slide to look at. Housing values since 1900. This is nationwide, so it's going to be lower than we have here in our current area. But in this situation, it doesn't go all the way out to where we are today, but we have gone up significantly since 1900. And if we were able to zoom in on different parts of this at different times, especially here in our Northern Virginia market, we've had downturns. During the 1990s, values went down a little bit and stayed very flat until the 2000s when they skyrocketed and they came down, which is the big dip you see here in the 2000s to just beyond 2010. And ever since that time, we've been on a steady growth chart since then, back up. The story I tell personally that affects my family is my grandmother bought a property in Del Rey in Alexandria City, which is right outside of Washington, D.C., near National Airport. She bought that house in the 1920s, about 100 years ago, and paid $2,400 for a home, which is just mind blowing. That house today, if you drive by it, it is still there. It looks awful. It looks like it should be torn down, but just the dirt that it is sitting on, because it's so close to Washington, D.C., is probably worth $700,000 to $800,000. And if someone tore that house down and put a beautiful house on top of it, it would probably be over $2 million. So again, housing in this area in Northern Virginia, again, I can't say that for the area you might be listening. If you're in another part of the country, that's to talk about with your local realtor. In our area here, is one of the greatest things you can have as a long-term investment. So to understand that, to make sure you know what you're getting into, and if you want to hold that property, hold it long-term, it can be an excellent investment. The other story I always tell is my father-in-law, who has since passed away, but he started buying properties outside of New York City where my wife and their family lived at that time. And he started buying properties and using them as investment properties. He bought every house on VA loans in the 1970s and the 80s. And he never put a penny in the stock market, but he basically had people living in those homes and paying his mortgage for him for 15-year loans on most of them. And my mother-in-law to this day lives off the income from the rental properties that they still own. If you are in an area of this country, housing values traditionally will be much higher than they are today. Then, and in the future, they're going to be much higher than they are today. So they are an incredible investment for the long term if you're in the right area. So again, to kind of summarize what we're talking about with this bubble and this correction, I do think we are in a much better situation today than we were in 2006 to 2009. I do think we will see some sort of correction here at some point. That's just the nature of our current market, but I just don't think we are going to see the dramatic downshift that we saw in those other years. So overall, our fundamentals are still very strong. If you listen to the National Association of Realtors chief economist, Lawrence Yun, who spoke earlier this year, they are very bullish on our long-term situation, again, mostly because of the overall foundations in our market are better since the collapse of the 2000s, because we have put many laws into place as well that help with the current situation. So I hope that is helpful information to you, and I'm going to pass back on to Susanna, who is going to take some questions that we will be happy to answer. And Susanna, have you gotten some questions from folks?
I have some questions here to answer.